You are listening to the REI Mastermind Podcast. Join JD as he chats with industry-leading real estate experts and professionals. We learn from their experience and uncover the strategies to their success that we can implement into our own businesses, and we can drive immediate results today. They share their experience and wisdom as we build a foundation to our own success. This is the REI Mastermind Network.
Well, we have Big Mike on the show, and I'm going to have Big Mike tell us his last name because I've slaughtered it a couple times here now. But we want you to direct you to his website, bigmikefund.com. And by the name of this podcast or his website, you can probably already tell what we're going to be talking about. And that's going to be investing in funds and maybe even some insider information there. But Big Mike, I really appreciate your time. And make sure you subscribe to his podcast. It's Big Mike Fund on your favorite podcasting app. So thank you for joining us today.
Thank you, Jack, very much. I'm humbled and honored to be a guest on your show. It's Mike Zlotnik, or people call me Big Mike, maybe because I'm 6'4", a bit on a heavy side. so
yeah, we got about a foot disparity between our heights. I'm short. And everybody's tall compared to me. So,
oh, no worries. Sometimes it's a big disadvantage. So it really, being tall is not always a big advantage. So
yeah,
but it is. The name stuck and the podcast stuck because of the kind of the nickname, and I couldn't come up with a more creative name. So it was Big Mike Fund because I'm a fund manager. So that's the history of the name.
So you bring up the fund. Let's jump right in. I think a lot of people are new to real estate investing. I mentioned a lot of people that listen to our show are likely newer to real estate investing. So can you just kind of give a little background exactly what is a fund, a real estate investing fund, and how you got into this?
Sure. So real estate fund, and I'm going to use a few, hopefully not too fancy words, but it's a diversified investment vehicle. At least our funds are broadly diversified. It's basically an entity, an LLC, way to think about it. The fund has an offering document, which is known as the PPM, Private Placement Memorandum. That's the formal offering document. But mechanically, what is a fund? A fund is an investment vehicle where you have many investors that come in and they pull the capital together. Not any different as a mutual fund on Wall Street. Many investors, they buy the units of the fund or shares, and they become owners of the fund. And then the fund makes multiple investments. And our fund, or our family of funds, each fund is focused on real estate only. So we take the investors' money and we invest into multiple projects. So a growth fund, we have a Tempo Growth Fund that invests into growth projects, and it's got a growth mandate. We have Tempo Opportunity Fund, which is a growth and income fund. It invests into growth and income projects. But the fund by itself is simply a vehicle where you have many investors and many investments, and it works as an intermediary to basically raise the capital, manage the capital, put the money to work, generate return, and then distributes the return to investors. That's kind of how a real estate fund works.
Sure. So how did you get involved in this?
Sure. So I had a previous career in technology. I had almost 15-year career as a technology executive, and I enjoyed that. But my passion has always been real estate. So in 2000, I started investing in real estate passively, and I loved the benefits of real estate investing. And in 2009, I was a little bit burnt out in the IT world, had a very successful career, but I was tired, and I loved real estate, and I had an opportunity to basically run a fund. So a friend of mine, many years, started the fund. He just said, "Won't you come and run the fund?" And I started running a real estate fund in 2009, and never looked back. It's been a journey. It's been a lot more fun for me. It's kind of my genius zone, the golden middle, where I'm very passionate about it. I'm good at this. And so that's kind of how it started. In 2009, I started running the first fund by virtue of my good friend starting the fund and then never running it and asking me to step in and run the fund. And then since then, I launched a number of other funds with my team. So
sure. So you probably have seen quite a bit. I mean, if you started investing in 2000 and then started to do the fund in 2009, we had that downturn, the financial downturn in 2007, 2008. What kind of similarities do you remember from then that you might be seeing now with the whole upturn with COVID?
So for the record, I never seen a downturn from the point of view that I've been investing in New York City since 2000. So New York City didn't see much of anything in 2008 and 9. We didn't see what happened in the Southern California or Southern Florida, none of the yo-yo thing. So as a fund manager, when I started 2009, that was the bottom of the it was past the crisis, and it was a great opportunity to come in. So I did not experience terrible collapse that happened in 7, 8, 9. So just for the record, I never seen that major drop. It's always been a pretty positive journey, but I've learned a lot of lessons by seeing and learning from other folks who were over leveraged, overstretched, over aggressive. So I've learned the lessons without seeing a big hit myself into what I've invested in.
Mm-hmm. So, one of the things that I thought was interesting, based on, they send over the interview sheet and to kind of introduce you, is that they definitely pointed out regarding some opportunities that you've been exploring regarding converting certain properties to, in fact, one of them says conversion of hotels to affordable multifamilies. Are you experiencing that in your neck of the woods?
Sure. And Jack, thank you for bringing it up. Yeah, it's been something that arrived sort of by virtue of the pandemic, but the challenges existed pre-pandemic. The pandemic sort of accelerated some of the difficulties hotels and offices have experienced, and they've become dysfunctional, and the highest and best use is no longer hotel or an office, and instead the opportunity to convert these properties into affordable multifamily projects have been the recent story and the recent journey. And we have at this point 9 investments in the sector, and we're loving it. It's been a great journey. We did one hotel to multifamily conversion pre-COVID, investing in 2019. It just sold in February of this year, short 21 months. And effectively in that one investment, we almost doubled in a quarter money, but 2.2 return. To make it very simple, we wrote $250,000 check and we got back $556,000 in 29 months. That was, if you compute the rate of return on that, that's a 73%. So we love that from economic perspective. That looked like a great opportunity. So we've been accelerating our investments and we love that thesis. So we started acquiring during COVID number of these projects, and they are, knock on the wood, they're running really, really well. It has a great do good part of the strategy, because do we need more hotels? Do we need more office space today? We need more affordable housing. That whole strategy seems to be dominating the headlines. And I'll give you some examples. We've invested into projects, number of conversions, or we call them extended stay hotels. So Residence Inn is an example. Mm-hmm. We have one in South Bend, Indiana, one in Winston-Salem, North Carolina. These projects, they look like mini apartments, and the conversion process is fairly easy. And we love that whole strategy and the thesis, and the numbers work better. The reason economics work is because conversion is fairly lightweight. You're leveraging existing property versus reconstruction. So you're building apartment complex without building it. You're just converting. And then the cap rates, again, if your audience is fairly new, the cap rates is just a fancy term, how in commercial real estate they quantify return on investment. The lower the cap rate, the higher the price. So the cap rates in residential is a whole lot lower than hospitality. So as a result, you're repositioning the assets where the same level of income trades at a much higher price. So economic thesis is there. You're building well below reconstruction cost. You're providing affordable housing, which is really hard to find. Nobody wants to build affordable housing now because if you could spend the dollars building, you could build more expensive stuff. So that thesis worked. We also invested in some office conversions to multifamily as office space became dysfunctional. And it's not clear how many years will it take for the business to come back. So those projects continue. There's basically two primary flavors of the ice cream. The one flavor is the extended stay hotels, like Residence Inn. You can imagine they look like mini apartments.
Right.
The secondary flavor of ice cream, I call them Ramadas, like Ramada Inns. So you've seen them. They're hotels that look like motels. And really the rooms are simple. You're basically not entering them from inside of a hotel. You're entering from external kind of from external points of entry, typically for a motel. And they're studios, but they work in an environment where there are colleges where students want to live off campus and they have an easy commute to the campus. They also work in workforce housing, kind of where people need their own place to crash versus getting a 1 or 2 bedroom with a roommate. You're doing it at a pretty affordable cost basis and you have the privacy. So the concept seems to be working. Yes, it's small space, but it's your own space.
Right. So what kind of things do you have to do to these apartments to convert them?
So besides, say, zoning and entitlements, getting the permission from the city to do it, sometimes the permission is already built into the zoning on that property. But if it's not built in, it has to be requested and approved. Beyond that, typically you're renovating external elements of the building, the roofs, the siding, making them fresher. Obviously, some level of common areas, changing from hotel meeting rooms maybe into some common areas, some spaces where people can go outside of their room and enjoy some kind of work environment. Plus, you're renovating rooms themselves. Pretty much you have to install kitchenettes. If it's an extended stay hotel, they may have kitchenettes already there. If it's like a Ramada flavor, you have to install small kitchenettes, so there's a way to cook in the apartment. You may have some improvements to the common areas, as I mentioned. Some of the hotel amenities, typically, could be a pool, could be some refresher on that. In general, these projects, if they piggyback on a not completely run down hotel, they can leverage existing structure, and it's incremental improvements. Instead of hotel lobby, you're trying to create more of a common area and enable residents to have, because you have a small room, you need to have some shared ability to have a mini library or whatever you call it, or an internet room, but so something like that. That's what happens with these properties. Obviously, again, age of the roof is important. What's the condition of the property? Everything probably has to be refreshed, from doorknobs to. It really depends on the age of the property.
Yeah, well, I mean, I've always heard, that's a common thing is to add some value to apartments. A lot of multifamily apartment buildings are acquired with that strategy that, they're undervalued, they're mom and pop situations, and you can make a couple changes to increase the rents or whatever. But what you're talking about is pretty significant, especially with the type of returns you're talking about.
Sure. So we do invest into value-add multifamily. So what you're referring to is projects where there is a aged property, mismanaged, and it needs curb appeal improvement. Obviously, many major systems, roofs, HVAC, and so on. We invest in those too. We understand that business actually pretty well. So the strategy is similar, except for instead of picking up an existing property with a bunch of tenants in place and quite often rents below the market, that value add is slower. So you take a multifamily where you have to renovate and then over time increase rents. It takes a couple of years to go through the process, sometimes even longer, because how many units can you do at a time when you have reasonable occupancy? This works a little differently from the point of view. You have a hotel. Depending on the hotel, sometimes you can stop the operation entirely and just work through it quickly. Sometimes there are a few buildings and you just turn off one building and you go through that, and you turn off the other building and go through that, and you're quickly converting them to the hotel. So the conversion and the lease up time is a lot faster on a hotel to multifamily conversion versus incremental renovations on a traditional value add multifamily project. Does that make sense?
Yeah, it makes a lot of sense. So, before we go any further, I wanted to remind everybody of your podcast again. It's a Big Mike Fund. So take a look at that. Also go to bigmikefund.com, and I'll make sure to include those links in the show notes. I understand that I think you also have a YouTube channel, don't you?
Yeah, we do. We do have a channel. Some of the podcasts are there, some of the educational content. This is something that I have a passion for. In heart, I'm an educator. Years ago, when I went to college, I'm actually a mathematician by education, but I almost went to get a master's degree in education. So I love a little bit of that education and giving back to the community. So I try to educate, and YouTube channel does have a little bit of that. There are a number of educational videos that I put out. I don't want to call it patented concepts, but it's a concept that I've pioneered. Again, the concept itself is not new, but I've developed methodology how to look at commercial deals in terms of investment quadrants. So the concept is fairly simple. Like Robert Kiyosaki has quadrants. I have my own quadrants, a little different. Here, I have quadrant 1, 2, 3, 4, and a quadrant 1 is essentially if you imagine a grid 1, 2, 3, 4, and they're going from left top corner to the right, and then one down to the left, and then one to the right. So quadrant 1 is a top left quadrant. It's an investment grade quadrant, and it's a cash flow quadrant. And quadrant 2, investment grade, then growth quadrant. And quadrant 3 is the speculative grade, more aggressive, taking a higher level of risk, but cash flow focus. And quadrant 4 is basically speculative growth quadrants. So this methodology helps myself and helps investors look at any commercial deal and just think, where does it fall? Am I taking the right level of risk reward? So I do a little bit of that, helping folks understand kind of how do you look at the investments opportunities, because the world is wide and there are a lot of bright and shiny objects, and you can get into the wrong investment, not really understanding the risk without a little bit of that framework as an educational methodology.
Sure. Well, let's jump into some of those risks. And, if people are interested in passively investing and looking at fund options, what are some of the questions they should be asking to make sure that fund is a good fit?
Sure. So the easiest reference is actually go on our website. There's an FAQ. We have an FAQ document on our website that actually compares with a bunch of these questions. And it asks, we answer these questions for our family of funds, for tempo opportunity and tempo growth. But some of the questions could be really, really basic. What is the fund strategy? It's one of the most basic questions. Now, what's really interesting, I have a book out also called How to Choose a Smart Real Estate Investment Fund. It's available on Amazon. If you search by Mike Zlotnik, you can get the book. And the book asks 10 questions. It's the top 10 questions one should ask before investing in a fund. So I'll give you these questions. What is the security of your investment? Probably the number one question, how safe is it, in other words? And the moment you hear guaranteed, safe, watch out. What is Bernie Madoff promise everybody? Guaranteed safe investment. So most of the private funds are not guaranteed, nor they are 100% safe. There's some level of risk, and you should understand that this is not U.S. treasuries. The only things that are sort of guaranteed by the U.S. government are U.S. treasuries. Everything else has some degree of risk. So the question number one is how secure your investment. And understanding a given fund and the strategy helps identify that. Number two question is, what is the return on your investment? What kind of rate of return you are projected to generate? Number three, how is the fund, what kind of income it generates, and how is it taxed? Very important. Does it generate short-term income subject to higher rates, or does it generate long-term capital gains? What is the fund liquidity? Some funds are highly liquid and some completely illiquid. So understanding what you're investing into is critical, because you can make the investment and your money is committed to for 5 years. If you want out, there is no way out. So liquidity is important. Next is, what are the fund fees? So as as the investor, you want to see alignment of interest between a fund manager and you as the investor. So if the manager makes a lot of fees, especially fees up front, and less as you go, and less on the back end performance, there's misalignment of interest. You want to see the reverse, where the manager is compensated when the fund performs. Payout frequency, quarterly, annually, monthly. What is the management team experience? Quality of deal flow. What kind of deals they invest in? Where they come from? Mm-hmm. Is this an open-ended fund or a closed-ended fund? Very fundamental question. So open-ended funds typically are evergreen funds. They continue to operate on periodic basis, whether it's monthly or quarterly. New subscriptions, people exiting, redemption, selling their units. They distribute income periodic basis. Versus closed-ended funds, they raise capital for some amount of time, put the money to work, and there is no redemption. They have to live through a life cycle. If they invested in a bunch of hotel to multifamily conversions, you have to wait for those to complete and to sell. So again, open-ended versus closed-ended. And then again, fund investment strategies is another important question. What does the fund invest in? What are the risks? Because the fund is a combination of multiple investments. So understanding the risks associated with a strategy is what creates overall risk profile on a given fund. I hope it's not too much.
No, those are great. And I hope people pause and jotted those down, because I think those are like vital when it comes to this type of thing. It's always amazing. You know, we could go down the rabbit hole on this, because I always find it interesting, because, you know, as a fund manager, you have the acquisition side, and then you probably go through a project management side. But in the end, do you also manage the property when it's complete, when it's been converted? Or
so we have a unique feature where there's a term for it. We call it fund of funds. There's no better way to put it. We don't operate a lot of these assets directly. We invest with operators, and operators run these properties. So from time to time, we'll wind up with direct ownership, but quite often we will take a piece or a whole, the whole deal, but there is an operator who is going to execute the strategy. Sometimes it's a partnership with operator. I'll give you an example. So we have a partnership we invested in with one of the operators. He's one of the mastermind. He's a member of one of the masterminds I go to. Mastermind called is Collective Genius. So it's a mastermind and movers and shakers, sharp guys. Mm-hmm. And he's in Mobile, Alabama. And I wouldn't normally invest in Mobile, Alabama, but because he's there, he's got the property management, he's got the know-how and operation. He was looking to buy a portfolio of 93 single-family residential properties, and we financed most of the equity on the deal. So we're not a direct operator, but we are partnering the deal. So we do this from time to time, investing into a given area in the given strategy if we have the strong feet on the ground in the form of a trusted third-party operator. That's what we do. That's the way to think about it. As a fund manager, the primary job is to identify, we always start with people. Who do we want to invest with, and what projects we want to invest with? So this is how we do it. Without a good starting person, we don't just go into a given area, even if it's a great project, because success of the project is really predicated on ability to execute the strategy. So It's not just, hey, let's get a good deal. Let's get a good deal and make sure that the value strategy, the conversion, the lease up can be executed. And if it doesn't exist, then it's not a good investment.
Mm-hmm. So you rely on some people, feet on the ground, to source these opportunities, and you help with the funding aspect.
That's exactly correct. So we spend years building these relationships, what I call them sponsors, operators, movers and shakers in their own markets. And a lot of the deals, the way they get done, they reach out to us and say, Mike, I know you got the money, you got the capital. Here's the deal. Can we work together to get it funded? Sometimes it's just a partnership. Sometimes it's a big deal. We've invested, have taken chunks of much larger deals. Give you an example, we have an investment from Temple Growth Fund into a very large value-add multifamily project in Indianapolis, almost 1,000 doors. And the project was so large, we couldn't take the entire equity, so we took only a piece of the equity, about a third of the project. So we do that from time to time to basically, first of all, we need to diversify. One of the most important jobs of a fund manager is to diversify across many investments to spread the risk. So one of the biggest benefits of the fund is diversification. But we will identify these very high competent high competence operators, people who we know, like, and trust, and then we write a check into the given project if the project makes great economic sense.
Sure. So if somebody had a project, like what type of information do you typically request? Like if it was a perfect packet of information, what would that look like?
Great question, Jack. It depends. So we always start with the, as I said, sponsor and operator. Let's just say we already have the existing relationship. If it's a cold lead, we don't know who they are. They can bring us the most exciting deal. We won't even look at it. I call it bright and shiny objects. I just don't know them. I can't underwrite the deal until I have a strong point of reference. Either we worked with them in the past, or there's a strong referral. That's part of a critical part of our underwriting. We won't take on cold business from the street. The second element of it is, what is the deal? Let's just understand, because it differs. Is it a value-add multifamily? Is it a conversion of a hotel to multifamily? Is this a self-storage value-add play? Is it an industrial property? So that really varies by the type of assets and the type of strategy. What we're looking for, essentially as much as possible, defensive characteristics of the investments. So what are the risks? What can go wrong? And what is the upside? And what is the execution strategy to do this? So I call them, in my terminology and methodology, are the light value add or heavy value adds. And if there's a light value add, the risks is lower. There may be a cash flow as you go, and it's an incremental risk. The upside is generally a little bit lighter because you're taking less risk. If it's a heavy value add, like a repositioning of an office to multifamily, or conversion of an old retail to a self-storage, or something, what I call, you lose the cash flow, you change the property, you develop or redevelop. It's speculative in nature. It's a quadrant 4 deal in my methodology. These type of projects need very, very competent execution. Who is the sponsor? How many of these have they done? Why is this one a good deal? And let's look through the numbers. How is it budgeted? How is it underwritten? What's the acquisition price? So I'll give you an example. Some of these hotel conversions. So we did a project in Winston-Salem, North Carolina, conversion of residents into affordable multifamily housing. So long story short, all in, conservative budget, $6 million. And we look at it, we looked at the numbers, and the numbers look conservative. It's 88 doors, almost 50,000 square feet. So price per door was good, total budget was good. What can we sell it for? And we look at this thing conservatively, and based on its projected income, it should easily sell at least $8 million, but it's got an upside for 9 or 10. So if you go through the project and you look in a very conservative scenario, you can still make the numbers work well, then you have limited downside and pretty good upside. And the execution itself, what are the risks? And if the risks are well understood in the competent operator, the project begins to shine. It's like you start adding these pieces together and everything seems to click. There's still risks. There's still construction risk. There's still, the permits could get delayed. Cost of materials and labor can go up. But overall, if the thesis is strong in the conservative use case scenario, then you can deal with the cost overruns at a little longer time. And that's how we look at these projects.
Sure. Well, I can't believe we've already talked a half an hour here, and I'm sure we could go even in more detail. But again, I wanted to remind everybody, head over to bigmikefund.com, and I'll make sure to have that link in the show notes. Look for the podcast, Big Mike Fund. But we'll end with this, is that I always know that there's a question you wished I would have asked. What question is that? And then we'll let you finish out the show.
So the most difficult question to every fund manager, and I'll give you sort of it's tell me about the big loser project. It's the most painful question. That's the question to always to ask. Have you experienced a loss, and what kind of loss it is, and what did you learn from it? People learn a lot more from their mistakes or from difficult projects than they learn from successes. So if any project manager, if you ask them the question, they can't tell you about a bad project or a bad situation, something's wrong.
No, that's a good point. I especially like that you frame it regarding what lessons were learned. in order to prevent that from happening again.
Yeah, you get PhD from a challenging project. You spend so much time and energy, and I hate to put it this way, you do wind up spending a lot more time on a challenging situation solving problem than on a success story. Success story is easy to talk about, everything went right, but you learn the lessons for sure from difficult or situations of failures.
Well, I really appreciate your time, Big Mike. I hope we can chat again sometime. Thanks for coming.
Jack, thank you kindly. I'm honored and humbled to be on your show. Would love to have you back on my show, Big Mike Fund Podcast, and hope we talk again very soon.
This has been the REI Mastermind Network. You can already tell that we've made some changes, and a few more are on the way. If you are interested in what we have planned, head over to patreon.com/REI Mastermind and support the show today. Financial contributions are always appreciated, along with a like, share, and review. It really helps us grow and reach more people with this valuable information. See you next time, and tell a friend.